All right. Well, I think we're good here. So why don't we get started? What do you think, Ken?
Let's do it.
All right. So the way we usually hit these off, thanks for joining everyone, is we do a personal introduction of ourselves, just who you are, kind of what you want to share about yourself. Let's keep it quick and simple, 30 seconds or so, and kind of describe what you're doing and your background in investing. Why don't we go down the list and start with Kelvin?
Yeah. Hey everyone, it's just being nice to be able to interact with you guys. I hope to learn more, to have good discussions. Been investing for close to about, I think, coming to 9 years right now. Initially, I had a lot of errors, in the way how I chose to invest. But I think third year, fourth year onwards, I got a lot better, and it's really true help from a lot of different mentors as well. So, look forward to talking to some of you guys and learn from everyone as well.
Awesome. Thank you, Kevin. And Kenny.
Right. Hey guys, I'm Kenny, and yeah, I've been investing for like probably about 10 years or so. I started off like trading options. That was like probably my first time trading stocks, and I lost a good bit of money back then, like probably about $2,000 or $3,000 doing, not knowing what I'm doing. But I've kind of like Kelvin. I'm trying to do like value investing. Just trying to find companies at below intrinsic value and just holding them for the long term. And yeah, and also selling puts on the side and options, just safely.
Nice. Better a $2,000 mistake than a $20,000 mistake.
Exactly.
All right. Thank you for that. Let's see. And then next up, we got Sean.
Hey guys, from Singapore right here. My name is Sean, just graduated college, and work-wise, I only had internships and got an offer in management consulting. However, due to the Corona pandemic, I was told that my full-time contract got pushed back by about a year because I was dealing with aviation sector, so it was hit pretty hard. So now I'm just taking a step back, reevaluating, and a lot of self-improvement projects. Investing-wise, I've been doing value investing, basically like a long-term buy and hold kind of strategy for the past 5 years, 6 years. This is just my own story. I didn't find much success. I just broke even basically. Then things changed a lot when I met this institutional trader who taught me many things about, how they do it in banks and like in the bulk bracket banks. And I learned a lot from him. Since then, this year, I've been doing a lot more trading in options as well as stocks. Yeah, so I found a lot more success in that. So yeah, it's my story.
Awesome. Glad to hear you found a mentor and was able to turn things around.
Yeah, it did.
I have a friend in management consulting in Singapore too.
Cool.
Yeah, that's neat. All right, next up we got iPhone. Who's iPhone?
Steve Jobs. Gonna show up, man.
His soul is here with us. Do we know who iPhone is, or should we move on to the next one?
Yeah, I think you should move on. Yeah.
All right, let's go to Annie.
Hi everyone, my name is Annie and I'm from San Francisco. I work in education as an international student recruiter, and I've been investing for the last about 6-7 years, primarily in real estate for single family homes in the Bay Area or out of state. I contribute to a Roth IRA, I contribute to stocks, but someone else helps me buy it through a financial planner. So I'm really more interested in learning more about the stock side, since I don't want to do 100% only in real estate. So just kind of see what other people, my age, what are they investing in and what they're doing. But yeah, nice to meet you, everyone.
Awesome. Sure, that makes sense. It's good to diversify. All right. Next up, we got. Oh no, the order got shifted. Al.
Hi, can everyone hear me okay?
Yep.
Hello, hello? Yes. Okay. So I was trying for like 10 minutes to get it to work on my phone. So I get a webcam. Otherwise it'd be connecting the Connect. That would be a big hassle. But anyway, I'm here now. Hello everyone. My name is Al Bona. I work at Illumina as a manufacturing specialist. I'm pretty much a beginner in any type of investing. I've got my 401k down. I've contributed to ESPP. Fortunately, we're doing really good as a stock, and I'm really looking forward to learning a lot more and pick your guys' brain.
Awesome. Thanks, Al.
Thank you.
Now we have Elaine.
Hey, so my name's Elaine. I'm from Toronto. I work in internal audit. I've been investing for about 3 years now, mainly in market tracking ETFs, but I want to switch over into more value-based or maybe even growth investing strategies. I would like to learn more about puts and calls, and I'm glad that I pulled out of the market in early January based on the yield curve inverting. And so that was kind of my trigger to pull out. And so I'm glad I did.
Nice timing on that.
Thank
Yeah,
you.
that was supposed to be like a huge indicator for a lot of people. All right. Let's see. We got Kyle.
Hi, everyone. It's my first roundtable call, so excited to be here and see so many of the talented people I've met on Facebook, but never face-to-face. So I've been investing for about 6 or 7 years or so. Started out mostly in equities, mostly some of the more, I guess, common tenets of personal finance, bogleheads, that sort of thing, more cut and dry. Whereas more recently, my investments have become much more esoteric. So most of my stuff I do now is like angel investing, a lot of crypto stuff, decentralized finance, DeFi, these sort of things. And I guess for me, the big topics I want to learn more about is definitely in the realm of real estate. So great to meet everyone.
Awesome. Thank you for that. And we have Sheena next.
Hi, everyone. Sorry, took my video off because I was eating. But my name is Sheena. I live in San Francisco. My background is that I'm an instructional designer for a electronic health system in San Francisco. I keep saying I'm a beginner, but now that I've been to a couple of these, I don't know if I should say that. Investing wise, I haven't invested anything. I'm still learning. To be honest, I've been really focused with my primary career. So a lot of the information that I get from these have been really useful, especially the books that were listed the last session. I definitely have like a full list investment library. So I'm actually looking forward to see what else has been. You're laughing, but I'm honest, there's like a huge library that I'm trying to invest in. But I'm looking forward to what's going to happen during this session, and really happy that there's more people.
Love it. Glad you were able to find lots of value from it. All right, we got K-Tai next.
Thank you, Sam. My name is K-Tai. I actually work in wealth management, but it's more from an institutional standpoint. So in terms of investing, it's a lot more probably institutional focus. So we work a lot with high net worth advisors or clients. And in terms of investment strategy, I actually pretty passive other than the private equity I have in the firm. But I'm just here to, I guess, hear other options and see how kind of everyone else is investing.
Awesome. Thank you, K-Tai. Now we have Gene.
Hello, guys. I'm Gene. I'm a realtor in the Bay Area, and I personally invest in real estate, and I'm here to learn more about real estate and meet with more real estate investors out there.
Awesome. Thanks, Gene. You want to go next, Ken?
Oh, yeah, sure. Sorry, I was just multitasking. Hey guys, I'm Ken. I'm one of the moderators of AIN. Thank you. It's great to see all the familiar faces and names. Fantastic conversation last couple of weeks. So glad to see that. As some of you might have known, I spent the last 16 years in technology strategy. I was a researcher, worked at a few startups, and most recently been focused on fintech and in my kind of personal professional life. In terms of investment, I've been pretty much 100% equities the last several years, and one of the reasons why I think AIN is so great is it allows all of us to explore other avenues, other asset classes, learn more about them, and learn best practices from each other. So yeah, I think I heard someone said that from Illumina, which is awesome to hear. It's one of the areas I'm really looking into around gene editing and gene sequencing. So it's great to hear that. But yeah, looking forward to hearing what everyone else is doing.
Awesome. Thank you, Ken, for hosting as always. We're here thanks to Ken's Zoom and hosting. And I guess I'll do my introduction now. So my name is Sam Fong, created AIN back in the end of February. Now we have over 2,000 members. So thank you very much for supporting, and really enjoyed the discussions that we've been having on the Facebook. For my personal background, I've been investing for 15 years. Start out with equities and branched out into private lending, then residential and commercial real estate and private equity afterwards. Nowadays, I'm really focused on the real estate, the private equity, and equities. I think that there is a lot of opportunity up here in this during this pandemic, and this is really the time when we can take advantage of the lower valuations and pick up some nice assets for the future. So thank you everyone for joining. And why don't we start off our discussion? Here is the first topic at hand. Where do you get the money to invest?
Like when we're younger or like right now?
Let's just say how you got started, like a quick introduction of how you first got started with the money, and where do you source money now?
Yeah, I do have a story to share, but I don't think my story will be any unique as compared to most of you guys. But just to share with you guys, so in Singapore, we have these things called like a neighborhood school, and we have those schools that are considered like prestigious schools, right? Branded, like called like branded schools, right? So I actually came from a neighborhood school, and then when I moved on to the next stage of education, that is where I went into like so-called like a bit more branded school. So the first time when I went out with my friends, I realized they're all wearing branded clothing. You talk about your Armani, you talk about your Fat you talk about your Benjamins, stuff like that, right? And I was just like, hey, shit, I'm not like, I don't even have any of that, because when you're young, you just think of, what's the best way to show off certain social status, right? It's about the things you wear. So I just realized, okay, I should get some of them eventually. So I went to Singapore, this whole stretch of shopping malls along this Orchard Road, right? I took a notepad, right? Went around, took down the prices of different items, and I said, okay, so now I know this how much it cost. And I went to the United States website. I say, hey, they're actually selling it cheaper because they don't have to pay rental, they don't have to pay staff costs. Essentially, I was just buying from United States, shipping in Singapore, and just reselling it on the forums that we see. Something like Craigslist kind of thing in Singapore. We have those. I was just buying and selling, and to the extent that my house was like becoming a bit of warehouse, that kind of thing. I learned a lot because in Singapore, people usually get the S and M size. I used to bring L size, but it didn't work. I used to bring like jeans, but it didn't sell well. Then I kind of knew, okay, probably do like polos, t-shirts. So that kind of generated around like 23K for me when I was just in around like 18, 19. But my mom didn't know what I was doing. Like she thought I was just like where are these clothes coming from anyway, right? But I was just like very diligent doing that, and I thought that was a great way, and I could earn money to buy the things that I wanted eventually. But the funny thing is that I never really wore those branded clothing because I felt that there wasn't a need at the end of the day. So that was just a small story of my like how I generated my wealth last time.
Can I actually maybe pose a broader question? So
Sure.
I think just focused on sort of investing strategies, right? Since this is focused on personal investing, I'm curious, and maybe you guys can use your little like raise your hand button, whether you're focused on equities, real estate, or other items right now. Let's just say raise your hand right now if you're focused more on equities than anything else. Oh wow, only got 2 hands. Right. That's interesting. Okay,
I thought it was
3.
like the raise your hand button right in the Zoom call.
Yeah, you can do that too. That's okay.
Where's the razor? Oh yeah. There's a raise your hand icon. Boom.
There you go. I like it.
Boom.
I like it.
Sweet.
That's that. So I mean, I think of the group, it sounds like it's a fair number, maybe 50%, and maybe a little more than that. So I think over the last few months, what we've heard a lot, and we had discussions of real estate. So it's probably not the forum to talk about real estate, but it's certainly an asset class that a lot of us are looking into. But I wanted to actually hear more about your equity strategy. As you build your wealth, where are you starting out, and then where are you actually allocating your wealth elsewhere? So does anyone want to volunteer kind of their perspective? I'm sure there's novice investors too. There's folks here who've invested for many years. Maybe someone can offer up their little perspective on how they kind of built it up, and then like the strategy they deployed as time went on. Raise your hand if you want to kind of share your story a little bit. Anybody?
I guess I can go.
Sure.
So as far as how I guess as far as how I built up my net worth, a good bit of it, half of it has come from just savings over the years from birthday gifts or Christmas gifts, like when I get cash for money. That's been a part of it. Also, I've managed to save quite a bit of money from work, just from my salary and my various jobs. I think like a good bit of it has come because when I started my current job, we worked a lot of overtime, so I got a lot of hours, and that kind of helped me to build a decent nest egg to invest. So in other words,
from your income, you were able to accumulate some level of capital to begin deploying, correct?
Yes.
Yep. But I guess maybe more pointedly, once you had that capital, what did you do to are you a short-term investor? Are you long-term? What is your mindset? What are you thinking of when you deploy your capital? What's your mindset when you do that?
Well, when I guess step one is I'm trying to look for the companies that have good free cash flow. I always look at the their balance sheets and their cash flow statements, and and the first thing I look for is to see if they have positive cash flow. So that means that they're making money, and in my mind, that's what I think. And then step two, I'm just trying to see that that company has a manageable to low level of debt, because I've just kind of been taught that debt kills. Debt is kind of like a bad thing for businesses.
So maybe I can ask the broader group, I mean, what is the filter? Does anybody have a unique filter of how they're looking at investment assets that they're willing to share? And feel free to just jump right in. And I'm happy to share mine too, just to kind of get things started. But if anybody has a burning desire. Sam, do you want to start?
What'd you say, Ken?
Sam, did you want to share yours, and maybe I can offer mine, and then we can kind of go around the room a little bit?
Yeah, sure. So I got started when I was 18 through mainly savings and selling on eBay. I started with 7,500. I put it all into one stock. It was called PANL, now called OLED. And the reason I bought it was because it had fantastic growth prospects and it had really good cash flows. They held the majority of the patents for OLED, you know, the lighting technology. And this is all the way back in 2005. So, you know, OLED was not really around in the mass market yet, but I could see that it would eventually shape the industry. So that's why I made that investment. Nowadays, I invest with the capital I've built over the years, and I follow a fundamental value approach with some growth inclinations. Basically, what that means is I have a long-term focus, and I look to buy companies at a discount, whether they are whether they're more of like a value company, like basically they have solid financials and fundamentals, and you're just buying it at a discount, or it's a company with very high growth prospects, like a tech company that has an insane amount of potential, and you're getting it at a fair to discounted value.
So quick question about that,
yeah,
Sam. Oh, just because you mentioned something that I'm curious to hear what the room has to say too.
Sure.
You know, specifically around valuations. Some people have mentioned valuations already, but how many people are actually going out there and running DCFs and discounting free cash flow, or looking at ratios, running market multiple kind of valuation exercises? If you are, raise your hand. I'm just kind of curious who's actually doing that today.
Raise your hand digitally or in real life?
Either one. Either one. You can raise your hand with Zoom, or you can do it over the camera. Okay, so Kelvin, Sam. If you're not, okay, I see a few people. Sean. Right. So it's interesting because I mean that's intrinsically, intrinsic. Using that word is ironic, but it's pretty much what you know, like, you know, Ben Graham or you know, Warren Buffett kind of espouses, right? They're looking for market like anomalies where the valuation is different from the actual market price. So then, if it isn't that, what are you guys doing? Like, I'm curious if anyone wants to share. Like you mentioned, Sam, something that's a high growth stock, for example, right? But you can't actually value that on free cash flow. So, who's actually like, what are your filters otherwise?
Can I just jump right in?
Go for it.
Sure.
Right. So, I do agree that with Kenneth, is it Kenneth? Yeah, that, you know, there are some stocks that are so hard to evaluate, right? Because based on ratio itself, they just don't tell you a complete picture, and that's the reason why my strategies have changed a lot throughout the years. And just a background story for that, I started with about 5 to 10K back when I was 20. Basically, I did the long-term approach, right? Buy and sell, and you know, valuing companies like tech companies and stuff like that. And I encountered the problem that you mentioned, which is how do you actually value a company if, you know, ratios don't work on certain companies like tech stocks, right? So what I do nowadays is I do a combination of fundamental analysis, although less, coupled with technical analysis. So I guess one thing that I just want to share with the community today is, you know, you can value a company and you can check off all the boxes in the ratios, right? By the end of the day, the stock might just drop in the short term, and that might freak you out. And, you know, I think that's something that a lot of people struggle with, especially if they do not portfolio size their trades or like their positions. And that's one of the topics that I found that I discovered this year, and it really changed the whole game for me. back in the past, when I didn't know what portfolio sizing is, I would jump in like 20, 30, 40, 50% just in a tech stock, you know, just because I feel that it's undervalued and I'm just gonna buy and hold for the long and make a lot of money. But you know, if it goes down, then my entire portfolio is not a good feeling, and it wrecks you up mentally and emotionally a lot. So right now, I allocate about 50% on long-term stocks. Like you can do your tech stocks and your FANG stocks and stuff. And the other 50% of the capital is deployed on trading, with a risk managed trade of around 2 to 3% per trade. That way, if the trade blows up, only 2 to 3% of your account gets destroyed. And if you go by statistics and probability, I think right now my win rate is about 77%. So that's good. So out of 10 trades, about 8 trades is in the green. So yeah, just make money off that. And so I don't really believe much in focusing too much on ratios sometimes. Yeah.
So Sean, a quick question then, and then you can feel free not to share if you don't want to, but how are you doing on the year? What's your ROI at this point?
ROI is about, in fact, this is a very interesting question, and it's also a challenge that I faced. So I had my best ROI this year during COVID-19, and that's crazy, man. It's about 20 to 25%. But okay, you guys might think, you might have the impression that, oh, I might have entered one trade, 1 or 2 stocks, and then that stock went up, right? That's usually the case for most people's portfolios, right? One big winner. But no, each trade made me maybe about $100 to $300. So that's how I slowly, I wouldn't say compounded, that's how I slowly grew my portfolio from 19.5K to about 23.5K right now. Yeah. So back then, couple of years ago, you know, when you buy and hold, maybe a 5% KGAR compounded annual growth rate is really good, and I'll be really happy. But just in not even 1 year, like 4 months, I make 20%. You know, it's sometimes the challenge is don't be greedy and just stick to your plan. Yeah. Yeah,
they also say statistically hedge funds are not even up. You just look at their return on investment generally is the normal curve. So you've got big winners, big losers, and everyone in between. And then on average, they're not doing better than S&P, which is interesting.
For sure.
Yeah. Well, I'll add my 2 cents, and then I'd be happy to pass on to someone else that has a perspective. But I mean, I've said this before. You guys probably heard this before. I'm always looking, essentially, not necessarily at stocks, but I'm looking at where the hockey puck is going when it comes to, and I've used this phrase over and over again, tectonic shifts in technology. I say this over and over again. And it's always for me about where the confluences of shifts in productivity, shifts in society, where those are happening. So I've been, you know, my first job out of school was actually right after 9/11. So I worked at a technology think tank under the Gartner umbrella. And it was my first time kind of seeing what was the outcome from essentially what was at the time considered like a pretty bad economic recession. Before that, the only one before that I was aware of was the long-term capital and sort of, there was another one before that. Long-term capital was 94. 87 was the sales, the sales and trading, like I guess the junk bond, essentially, Michael Milken, if you guys have read that. So all those situations were financial policy driven. 9/11 was essentially one that was, I guess you say, geopolitical risk driven. And then between the time in 2020, I mean, obviously 2008, but you saw like the way technology started evolving and eliminating some areas of industry or consolidating them. You know, Amazon was started in, I think, 1994. 99, it was about, you know, $18, $19 a share. And then like you saw the way they operated all through the thousands and then the 18s and so on and so forth. These companies essentially suck value. And because the way the United States economy works, you have these humongous monopolies that just emerge, right? And like what I notice is that this happens over and over again. So if you call the next monopoly, and I don't give a shit about the next, I don't give a shit about MongoDB, for example. It's a great company. You can invest in, you can make like a couple bucks now because the entire market's going up. But MongoDB is not going to dominate the world, right? I care about investing in the companies that are going to suck up value for everyone else. So the next Amazon, which I mean, I would still invest in Amazon to be honest. The next Google, the next Facebook, maybe not Facebook today, but you know, maybe in 2004, for example. Like that's who I'm thinking of, and whether it's a, a phone, a car, maybe it's a confluence of technologies that don't quite exist in the way that the market can accept yet, like 5G or like blockchain. I'm looking at who's going to dominate where the puck is going, and so that's my filter. And what I do, I go all in. I don't give a fuck about. Sorry, excuse my language, but I don't care. I don't care about diversification.
I like that.
Yeah, no, I've said this over again and again. Diversification is basically insurance for uncertainty and idiots, because and I'm sure many people will diversify, but and that's totally fine. That's your strategy. It's the way you want to conserve capital. But if I know something's going to destroy the rest of the competition, I'm going to put 50-60% of my capital into it and see where it goes. That's how much certainty I must have, though. That's the thing. I must be looking at like what their intent, who the CEO is, what their intent is, what technologies they're either creating or inventing or destroying, like that kind of thing. So
that brings up a really good point, and that's a lot of what we do in investing. There's like a quantitative component to it, where we analyze all these, say, ratios, or technical traders might look at price movements and charts and other moving averages, that type of thing. And then there's also the qualitative aspect, which Ken just discussed, which is basically you got to make a value judgment call. Like, how do you know which industry is going to kill it in the future? Could it be like, say, the electric car industry in the 70s, where there was a lot of promise, but it fizzled out for around 30 years? So I think there's like a very interesting play between the qualitative and the quantitative analysis. So I'd be curious to hear more about that. Like, how do you guys balance your judgments and try to make it as objective as possible?
Hey, Ken, this is Wilmer.
Hey, Wilmer, how's it going?
Long time no see. It's been years.
Yeah, it's been years. Well, love to catch up another time for sure. The coffee, yeah. But glad you joined.
Yeah, thanks. I've been exploring I went through the tech boom as well, and I've had multiple stocks go to zero to me. I'm very proud of that. And yeah, like moving towards the puck and all that kind of stuff, it's all great. But now that I've got a little bit more gray hair, and even right now I'm looking at one IPO stock that I find that has a lot of great potential. It's solving a good problem. But my question is always, at what price? So what's your entry price? When do you just go? You can always dollar cost average on dips. Maybe that's the strategy. But my biggest thing right now is the market is crazy. I don't know of any entry price right now.
Yeah, it's a good question. I'll give you my perspective, and maybe other people have others. But I think you pose a very important question, because we also talk about like when things go well, stocks going up or values going up, whatever. But we don't really talk about our exit and entry strategy. For me, let me caveat this by saying, I do care about quantitative analysis. Like, I will run a valuation exercise, and I will look at free cash flow. I will look at debt to equity ratio. I will look at bookings. I'll look at all the important stuff that's on the 10Ks, right? But again, like, that's only 30% of my filter. For me, intrinsic value doesn't capture like exponential growth, which is the only thing I care about, because we see this happen over and over again. The most game-changing companies reinvest their capital to keep ahead of their competitors. That's the most important moat you can have. Like, if you're a mining company, your moat is essentially acquiring as much like mines as possible. Or if you're I don't know, Disney, your moat is I want to own as much great content as possible, capture the audience. For high growth companies though, like you have to allocate capital towards essentially R&D and development. So it's impossible to kind of properly value something in that way. So long story short, what I'm saying is the entry point actually doesn't matter to me, because for me, it's like the opportunity cost of missing out on a great company is too high. I will buy as much as I am able to, within reason, obviously, with enough capital to kind of maintain my proper personal finances. But of course, every additional piece, any capital that I know I can invest, I will enter, because I only invest with conviction. So, and then, I mean, for me, the exit point is maybe 10 years away, 5 years away. It's when I need it. And that's the kind of like conviction I want to have, because I'm not going to invest in something I'm a half-ass about. I'm going to do my homework and study it to death. It's the reason why I spent 9 months studying blockchain. It's the reason why I spent 9 months studying AI. Like, I want to know what works, why it exists, why it's important, right? So that's kind of my filter. Sorry if I'm rambling.
That's a very interesting take on it. It sounds like you do like a deep dive and basically gain all the industry knowledge that you need to make a very confident investment.
Yeah, the short of it is I want to have conviction. If I don't have conviction, then I'm just basically gambling, right? I don't want to be a gambler. I want a sure thing. And that's the reason why I only invest in certain things once in a while. I'm not just, you know, I don't invest in for investment's sake. I will sit on capital until I know that I'm 100% sure I want to invest in it. And sorry, I heard someone say something.
Oh yeah, I have a question for you. So, have you ever encountered a situation whereby you did your homework for a company, or like your blockchain or crypto, whatever that is, and you're super convicted? So you throw in, like I quote you, about 40 to 50% all in on that one underlying, and then it didn't go well. Did it happen before?
Yeah, it has happened before. Let me think the last time that actually happened.
How do you take a hit though? Like, that's a 50% profitable loss. That's a big deal, at least from my perspective.
Well, here's the thing. I don't. So like, I guess I've never been that. I've never had such high conviction and have the stock fail on me long term. Meaning, like, it went down, so it gone up, and I lost money. Most of the time, the result is I either exited too early because I was being emotional with the market, and I was like sort of tied to the news cycle rather than looking at the fundamentals. Because you have to really be iron stomached. For example, like, we can look at like incredible movement going on in Tesla today and say, like, yeah, it's going to go down because it's way overvalued. But then the question is, like, overvalued in what like time scale, right? Or it's the stock's fluctuating, going down based on what news? It's usually something that is a catalyst that is short term in nature. So what happens is I exit during the times when, you know, things are like, there's bad news, and then over like 3-4 months later, something else happens and it's good news again, and suddenly you see the stock go back up. So like, I guess the short answer is, number one, like, I won't invest in something that I'm like pretty, like, for example, there's ICOs and investing in Bitcoin, right? At the peak of Bitcoin, that happened, and people lost a shit ton of money because they went in at 20K, for example. But that's because you went in on FOMO. You didn't study its patterns, you didn't study its history, and you didn't understand like what are the catalysts of, say, the network effects, right, of the Bitcoin network. So for example, it might be the halving that happens every, like, you know, every couple of years. or there are like certain dynamics regarding who the miners are, where they're concentrated. Like if you don't understand that and you're just investing because it's 20K and you think it's going to go back up, then you've not done your homework. And that's a case where a lot of people lost their shirt. So I wouldn't do that. What I would do though is I would sell on emotion, and that would happen. And I'd be like, shit, I lost money because I went in at a different price. It's a hard question. Maybe I'm lucky in that respect. Maybe I've just been so cautious that I haven't put myself in that situation yet.
Right. Thanks for sharing. I think those are really good points. And yeah, I think yeah.
No, Sean, you go ahead first.
What was I gonna say? Oh yeah, I was just saying, sometimes it's just so hard to value a company, and I guess everyone needs to strike a balance between your conviction and what it really is, which are the ratios, right? Let me give you an example, right? 5 years ago, I researched a lot on Shopify. Back then, I think they were like $50, $60. I can't remember. That's the ballpark figure. And I sold it at like $80 or $90. And look at it right now. And the reason why I sold it is because, like I mentioned when I did my intro, 5-6 years ago, I was a value investor, and ratios got to all check the boxes, right? But back then, Shopify didn't check all the boxes. But although I really believed in it, I just went along with by the book and say, oh shit, they are not doing well in this ratio. I got to exit right now. And yeah, I guess it's so hard to really know, value something. And I think at the end of the day, you just got to know how to manage your risk and be able to take the loss if it happens. Yeah, that's the story.
Sean, I have a question. This is slight divergent. Portfolio sizing. So recently I came across, I'm trying to work my portfolio right now. I don't, I think for me, I think I'm probably one of the older guys in this group, and portfolio sizing, allocation is very important to me. You got to preserve your capital at some point in your life, and you can't risk it all. And there's this term called the Kelly criterion. You've heard of that? It's like how to bet. It's about what's the optimal way to bet based off of some probability. Say like if you flip a coin and the coin has a 60% win rate, how much of your portfolio should you be betting on a 60% win rate stock? So like, can you share some of your portfolio sizing? If I go to a financial planner, they'll say, oh, what's your risk tolerance level? They'll say, okay, if it's medium high, you should go bonds like this, gold like that, cash like that, real estate like that. I mean, it's a big question for me.
Okay.
Can I just jump in on a Kelly criterion thing?
Sure.
So actually, I have done that understanding like almost 5 years ago. But if you understand the formula, basically you have to assign probability of it going up by certain percentages, right? Like, so what's the probability of it happening? That's the first thing you need. And second is that how much gains will you have? And that kind of forces you or helps you to put certain position sizing. So, I do realize after a while, certain theories, while they are elegant in theory, when it comes to real applying the practicalities of it, I find myself struggling a lot because those probabilities and assignments are really, what is to say, the probability of it happening is 80%, 70%, why not 75%? It's all very, just pluck out of the air. So I don't really base on that, but just want to share my experience with the Kelly criterion issue. Yeah. Sorry, Sean, back to you.
Oops. Yeah. Great sharing, Kelvin. So answering your question, Wilma. So, okay. If you guys got a better suggestion, feel free to jump right in. I'm just speaking based on what I learned from my mentor, who is an institutional trader in a huge bank, right? So I learned risk management from him just this year, back in March. So the best practice that they do in the banks right now, according to him, is every trade. Okay, so Wilma, just the context is every trade or every I wouldn't say every position because they do trading. So it might not be relevant if you buy and hold. All right. So this is for short to medium term trades, like maybe within a month or within 2 months, you enter and you exit. It's good to just base your trades with a risk of about 2 to 3% of your portfolio. So let's say if you have a 10K portfolio, you want to enter a trade that's only $2 to $300 per position with a max at 5%. So that's the max risk that I'm taking right now. So that what this means is if I enter a position and it goes to zero, I can be very sure that, okay, the max that I lose will be 3% of my portfolio. So that's the best practice that I've been doing right now. Yeah, so just my thoughts.
Yeah, so I think I want to add another dimension to what Sean have shared, maybe from holding stocks perspective, right? So at the end of the day, I think when we want to size our position correctly, I mean, if you look at Kenneth's case, right, he definitely is very certain of certain ideas, which is why he is able to size it appropriately so that it moves the needle, right? It cannot be like you do one work for like 1 whole year and you just add up 2 positions sizing in your portfolio. It doesn't make sense. It has to move the needle. So I think what is the best judgment on how you size the company is how confident you are. And when it talks about how confident you are, is how familiar are you, because I feel that what lowers down our risk is that, how much we know about the technology and what are the metrics we can track, So for instance, I invest in this company called C Group. So they own Asia's largest e-commerce company, Shopee and Garena, right? So in terms of the Google Trends, in terms of the app rankings, that's something I can track on a daily basis. Even if the quarterly results are not even out, I'm able to know, what is the direction of it, whether the business is going to do well or not. So some companies where I don't have certain, ways to track it, to know the performance, then I'll put a lower percentages, right? So things that I can understand really, really well, those are my biggest positions, and they turn out to be companies that do well. So I think at the end of the day, it really boils down to how familiar you are, how confident you are, and what are the metrics you can track on a regular basis, right? So for example, if I'm investing in an e-commerce website, there are actually websites that actually allows you to track the traffic visits, track the number of visitors that visit the websites. So although it may not tell you the real sales figures, but even if you close both of your eyes, by next quarter when they come out, the likelihood is that this e-commerce business is going to report a higher revenue growth. So I like to see things before it happens. And hopefully there are some websites, some analytics that tells me that.
So you're looking for as much proxy data as possible.
Yeah, alternate form of data as well.
I think the part where we differ the most is like Calvin is more long term and I'm more of like short to mid term. So I think depending on how you're gonna invest, Wilma, that's where you're gonna think about how you're gonna risk manage your portfolio differently. So if you're going for the shorter to mid term trade, you don't want to enter such a big percentage. Whereas if you're doing for the long term, then maybe you can afford to have a bigger risk appetite, maybe about 10-20% or even more. Yeah.
I think this asset allocation talk is a very interesting discussion about strategy, because like several people have been saying, it's really about where you're confident that you're going to earn the highest returns, right? So for me, I have a mix of portfolio. I have a mixed portfolio. I have equities and I have real estate and I have private equity. So the way I personally figured it out was, what is the minimum amount of cash I can get away with investing in property? And then I'm going to put the rest in equity. Because the interesting thing about real estate is I don't necessarily need to use my own cash to invest if I can work with other investors. So when I bought a house in Sunnyvale recently, and I basically put the very minimum amount that I could use in that, and I'm putting the rest in equities, because I think that this year equities is going to be the key. Like if you bought anything back in March, you probably already doubled. So I think there's lots of opportunities, but generally it's really based on where you have the most conviction and what your reality is. Like, if you're going to allocate a certain amount, a certain percentage towards an asset, what does it do for you, and how does that work with your risk management?
Yeah, Sam, I agree. But I think the other thing to take into account is major macroeconomic factors. And again, some of you guys might have heard me talk about this before, but you know, the traditional wisdom is that, you know, you put something in a, you know, CD, it's going to earn a certain percentage. You buy fixed income, you get a certain percentage. You buy real estate, it's going to appreciate a certain amount over time. But also, like, we have to acknowledge, like, this is definitely a very unique investing environment, which is why you see value gravitate towards certain asset classes.
It's
right?
crazy.
Yeah, it's absolutely insane. Like, so I mean, a great metaphor to the U.S. economy today, and maybe even actually many European economies, in fact, is Japan in the 1980s, right? So for the first time, I mean, they're one of the first major cases of countries after the Plaza Accords, which I'm sure you guys can read up on basically. Well, I don't want to get too political, but basically the U.S. bullied the Japan into certain kind of trade agreements and interest rate agreements, and Japan never recovered. And so essentially, what they did in their monetary policy is that they simply didn't have any other choice but to go into like near negative interest rates. And to this day, they still suffer from sort of that stagflation situation. So what happens when your interest rates, when your alpha, well, let's just say this: when interest rates go to zero, fixed income, corporate debt, any kind of debt becomes basically nearly free money, right? But then if you put anything in, and just say you're an institutional investor, you put anything in those assets, it's not even keeping up with inflation. So you have to find alpha somewhere. So if we can make a conjecture that the institutionals are trying to find alpha, they're going to seek alpha in a few things that are appreciating in value. And that's why you see this value sucking behavior happening in the equities market, because frankly, alternative investments simply aren't de-risked enough. You see also in the current economy near oligopolist. You basically have oligarchies essentially, right? And near monopolies. So, you know, if you're a small guy comparatively, like you, me, and other folks, unless you guys are not telling me anything that I should know, you know, then you're just basically you have to kind of figure out where the capital flows are going, which is why I mean, that's why I explore alternative, like, for example, currencies are interesting to me because, you know, you go through the history of currency and essentially it comes to control. So decentralized currencies like Bitcoin and Ether, they create an alternative to essentially the reserve currency of the US dollar. What happens when the petrodollar trade, for example, petrodollar means essentially the world is buying dollars to buy oil, right? So think about that. Like Argentine pesos, Argentina needs to have a whole bunch of dollars to buy basic necessities to do trade with the rest of the world. So let's just say you have a really viable alternative, maybe the renminbi, or maybe it's Bitcoin, and there's no, like, basically the world economy shifts, right? Where does value gravitate towards? What is independent, like what exists, what is value sucking, but also like independent of those kinds of like exposures, risk exposures, geopolitical exposure, country risk, credit risk, all those things. And that's kind of the way I kind of explore, like, well, where the opportunities are. So I mean, that's the context we invest in now. We don't exist in times that are similar in any way, with some small, obviously some similarities, but it's extremely different from the 1990s. It's very different from the 80s, very different from the 70s, maybe closer to the 70s, perhaps. I don't know. But yeah, it's just a thought, guys. I don't know if you guys have thought about that.
Hopefully not the 70s.
Well, we did have an oil shock almost. The opposite direction, though.
Yeah, but I think that's a great thing to consider when we look at our asset allocation. I think for people who don't have access to what institutional players are doing, it's best to just try to stay apprised of what is happening in the larger economy and invest accordingly. I think for people like me and K-Tai who work in wealth management, we get like I guess like a step ahead in terms of like seeing what the institutional players are doing, and we can invest accordingly. But you know, the wealthy institutional investors, they have to seek somewhere to deploy the capital to, and although they have access to more lucrative opportunities within each realm, they also have to seek the same types of asset classes. They're also investing in equities, they're also investing in real estate and so on. It's just a matter of how you can determine which type of assets present the greatest opportunity for the lowest risk. And I think that's going to be true for equities for the foreseeable future. For example, there's never going to be a completely efficient market. So if you can identify those opportunities that creates a value advantage, then you're going to do better. I think that's just the way it is. I think that brings up another interesting point. What do you guys think of diversification versus concentration? I know we've like talked about it back and forth, but I kind of want to see, like, do people here generally like to concentrate, and who likes to diversify? Because I've heard a lot of people who like to concentrate. A lot of us are in like 100% equities or something like that. But who does anyone believe in spreading it out, or how do you spread it out? And what's your justification?
I answer your question with a question. How do I know that I know more than someone else? And how do I know that it's all? I would say, market's efficient. I'm not smarter than anybody else. It's built into the price, and thus I don't buy. That could be the result, right? I might. So I've got a very strong opinion about Apple, for example, and I think like some of the stuff that they're doing is like world beating, like such a big moat. But then I'm not sure if it's built into the price. That's where that's because I've got a big position in Apple, and I even feel more confident about them. But I'm at that stage where like I gotta hold back. I gotta resist buying more Apple.
That's a great question. Like,
Well,
how do you determine?
I think that's a little bit about expectations.
Mm-hmm.
So the price at any given point is a combination of expectations at that moment.
Mm-hmm.
So someone like Kenneth, who has very strong expectations about a certain sector or technology,
Mm-hmm.
maybe very few people share that. So that's why that position may not really be inflated yet. But you look at like Zoom or a Tesla, or, you know, where everyone's rushing in, and all those expectations are piling on and on and on. And then at some point it's like, well, how much higher can it go, unless they do something really out of the norm to push it. And, you know, maybe Elon Musk sells another vehicle and then that causes it to go up another 100. But I think that's kind of what you're talking about, is more about just the modern portfolio theory and the efficient, you know, market hypothesis with everything being priced in, which is very much kind of the investment philosophy that the firm I work at is focused on. So I think from the diversification perspective, for people who are not necessarily too experienced with and going to spend the time to do all the research, they're probably better off maybe diversifying a bit, unless they have very strong convictions about particular positions and they're willing to have a risk tolerance to see it, you know, fly around.
Yeah, if I could add 2 cents here. I actually, I mean, most of the famous investors you've known about have in one way or another had really strong convictions about something. Like
They
no
also
one
have-
has ever become Warren Buffett by,
And-
or you know, like Jim Chanos, for example, famously shorted Enron. Jim Chanos is a famous short seller. Since then,
can
oh,
I
sorry,
just
go ahead.
can I just
Yeah.
interrupt? All those famous investors also had inside information.
I don't necessarily believe that, actually. I mean, for sure, like when you move like capital of these kinds of blocks, you probably have an audience. I mean, this is why Ron Barron, for example, has a little more insight into Tesla than most of us do.
Mhm.
But fundamentally, you can look at the product roadmaps of most of these companies and say, there's something here that the market's not really realizing. I mean, I believe the markets, for the most part, U.S. markets are pretty efficient, without a doubt, actually. Most information that's available to the public will be priced in. However, that's the limitation of the market, right? The market doesn't have the foresight to connect the dots and figure out and say, okay, I know that this is the information available to the market right now, but they don't realize something. They're not accurately valuing a company. For a great example, and you know, it's common knowledge, right? People always say like Tesla's overvalued because it's a car company. They only shipped, what is it, like 500,000 cars in, you know, a period of time, compared to GM or Ford, who shipped millions of units, right? But I mean, the realization that many people recently had is that Tesla is actually a vertically integrated company in the same way that Standard Oil or Carnegie, Andrew Carnegie and his steel companies were. The reason why those companies became so incredibly large and valuable is because they created new markets, and they maneuvered their ways into a near monopolistic or monopsonistic position. So one could then say what the market doesn't realize with Tesla today is that it should be priced like a software company, because it's not just a car company. It's a battery company. It's a energy storage company. It's a virtual power grid company. It's basically the iPhone in a car, right? It's a platform, but no one realizes that. And as you sell more full self-driving packages, that's pure margin. Like that's one hypothesis you can make, right? So that's the thing that I think takes a little more homework, and that's where your conviction should come from. Like, I mean, that's a market realization that's not quite priced in, if you think about it. I don't know if that kind of made sense, guys, but
no, that made a lot of sense. I like that. Thanks, Ken.
Okay, so I just want to share my experience. You know, when I first started, you know, it's a lot of times you basically really do not know what you do not know, right? So it's really tough. And I think, you know, you want to diversify as much as possible. You know, you want to learn what industries that you think you will thrive more, you are more familiar with, what industries you don't want to touch. For example, biotechnology, you know, if you think you can't read any papers or scientific journals, then probably, you know, you're probably like me, then you probably want to avoid the industry. But after a while investing, you realize that, you know, you really want to be a bit more concentrated, because you know your style, you know your flaws, you know your weaknesses, you know what you're good at, what you're not good at, and you tend to want to be concentrated. So that was what my initial experience was. And when you do concentration, it's true that your wealth would compound really quickly. But I still remember when I hit a certain amount, and I thought that, hey, you know, this strategy of concentration really works. And you know, you just have to make one small mistake, you know, it could really set you back in a very big way. So for example, I guess it was 2015. One of the concentrated position didn't work out well, and I lost quite a bit of money, and that set me back like 2 to 3 years of progress, you know. So I do really went through a hard time of reflection again. I think, yes, it's okay to be concentrated, but not as 40 or 50, because the price of you getting it not incorrectly is just too high. Let's say you could be growing your wealth so well in the 9 years, 10 years, this whole streak that you have, but just that 1 year where you lose 50%, that is an enormous amount of money, and I think the risk is far too high. But I think typically for me now, I feel that I'm more comfortable with about 6 to 8 positions. By holding, if I'm holding 3 or 4, I think it's a bit more risky. I think that's just my view.
I think that's a good point, and that's something that I follow too. Something that my mentor, who runs a $1 billion fund, told me is basically the way he looks at investment is very simple. How much will it hurt me if I'm wrong? That kind of tells you how much you should be able to invest in something. If you're wrong about something, how much would it hurt? And that's why I think that it's good to concentrate, because if you're sure that it's going to perform, then obviously you're going to make much greater returns. But you do want to, at least for me, you do want to spread it out so that it won't be heavily damaging to your finances, because we don't always have perfect information. No matter how much research we do, how much we read and so on, things go wrong and things don't always swing your way. So I think something around 10 stocks or under is generally what I try to shoot for.
Right.
I mean, you can always hedge your bets with the market. I mean, very few people can beat the market anyway over the long run.
I think also for me, it also I think it's really time dependent. Sometimes, so like for me, I generally have pretty strong convictions about a few. So you start macro and you drill down deeper. That's kind of how I like to do it. And there are times when you would be a lot more convinced of something, like, for example, like if you're super convinced, like if you work near the airport every day and then you're seeing like a bunch of people going back on flights or whatever, or you're a TSA agent, then like you may have like inside information and maybe you can become super convicted, and that's on you, right? Like ultimately it's your decision. With good risk management, with good position sizing, like you can become convicted, and as things go better, you can go more and more in. But sometimes if you just don't have the time or you don't have the conviction, then yeah, like it's much better to diversify back out. So sometimes I would be, there are times when I would be 70% of all my money would be in cryptocurrencies and they would be actively trading, like recently. And then as kind of things start to slow down, I would pretty much rebalance and shift things back to more stable portfolio. But I like to actively put my money in things that at the time I'm really convinced are going to return higher yields. But so that's kind of how I view it. Is like it's not really just I put everything into the S&P index ETF and let it hang out for 30 years. But a lot of my money does, you kind of get diversified at different points in time. So it's like almost like diversifying based on the market condition at the time too, I think, if you kind of want to do the research and handle all that. But yeah, and on the point of insider stuff too, I think it's like pretty important to have that level of insight. Like you don't have to be working, you don't have to be like an executive vice president at Apple to kind of have conviction on where Apple is going. Like you can get a list of Apple's recent mergers and acquisitions, like that stuff's all on Wikipedia. You can understand like where kind of their product mindset is. You can even just like, if you talk to like people who work at Apple and what their kind of focuses are on, like you can get a pretty good sense of where it's going to go. So like for me, I'm I don't really know a lot of stuff. My background is in computer science and biomedical engineering. So a lot of my stuff is all in tech and biotech. And it's not really in like a lot of other things, but like I manage my risk because, you know, if it goes down below a certain price, then I'm going to exit and reevaluate some other opportunities. If I'm just not doing right, or like my psychology is off, then yeah, I'm going to diversify into kind of a way more stable portfolio so that at least it's kind of beating inflation and but I'm not doing anything risky while I kind of like get my mental state together, get the time together before I go research again. So like, that's kind of how my approach is. But you know, it's a lot more active also, and it takes a decent amount of time.
Makes a lot of sense.
Can I actually pose a question that might be interesting to hear from everyone in the room?
Sure, go for it.
So I know there's folks that are really pro diversification, which is 100% great. Personally, I feel I don't have the brain power and time to study deeply 10 companies. I just can't. I only have the time to focus on, say, 4 or 5. Maybe 4 or 5 would be like my max. But I'm gonna definitely follow 2 or 3 and like be like that, you know, these are my guys. That's what I care about. So what I'm curious about from you guys is what do you guys have conviction in right now? Like feel free to share your wildest theory and let's talk about it. let's break it down, you know? Let's chop it up.
Can I preface that? Can I preface this? I'm actually thinking the same way, and it'll set you up. So, like back in March, right? If you when you saw the market downturn and you say, okay, this is unprecedented and all this kind of stuff, and it's like, great, it's we're in for a shit show. If we would have had this meeting right now, we could have said, okay, this is a structural shift right now. Who's gonna win? And we would have sat around the table and we could have probably guessed who could have won. Online, grocery stores, those kind of stuff. People would be more social distancing because I think there's some precedented right now. But so that's like an exercise of like how do you look forward in the next couple months? And I think you're asking the same question right now, Ken. Is like, how are we gonna what are we looking forward to in the next few months or in the year? And asking this question now is much harder than asking that question back in March.
I think that's a good point.
This question is always hard. It's always a hard question to ask.
It's hard to forecast what's going to happen in the next few months. I look at it at a slightly different approach, Wilmer, which is I'm not so concerned what's going to happen in the next few months because my take on it is I can't predict it. Instead, I look at if a company is going to be really strong in the long run, I want to buy it at a discount. So for example, I bought a lot back in March and I invested most of my allocation back in March because all the valuations were dropping and lots of great companies were basically just dropping with the overall market. That's like a surefire, that's like a pretty good bet. If you're going to make a heavily concentrated bet, it's when a strong company with excellent financials that's going to be around in 10 years and is going to kill it in the far future is dropping with the overall market. That's the kind of thing that I like to look for because your risk is basically that it's not going to go back up. But what is that risk actually, right? If it's dropping with the overall market and not something intrinsic to the company itself, then it's eventually going to go back up because it's just a strong company. So a couple of examples I would like to suggest are in the 2009 crisis, I also heavily invested everything I could get my hands on. I borrowed money, everything, 100% in equities, because I knew things like Starbucks at $9, like that's a no-brainer. Starbucks is not going to collapse and it's just going to go back up. So all I have to do is buy it and wait. And lo and behold, it's like $80 now. You know, unfortunately, I sold too soon. I pocketed like I pocketed what I thought was a handsome profit, and you know, But you know, things like that. Also, other things like Visa at the IPO. When is Visa gonna go down? You know, the company has like a near, it's one of, not a monopoly, but it's one of the only big players in the space, and we're moving towards a credit and less cash society. So it's gonna grow all that time, and bought it back at IPO, never looked back since. It's just a really great company. So I like to look for my strategy, I like to look for these no-brainer opportunities, things that you know are going to do well based on whatever knowledge that you have and whatever research that you've done. And it's been unfairly punished by recent events, or its share prices have just tanked because of something unrelated to the company. That's when you know that your risk is largely mitigated by the fact that that's just market risk, and over the long haul, you're going to make back much better what you're going to do in the future. So,
but Sam, what I would add to that is, yes, those huge market dislocations driven by geopolitical, or in this case, pandemic, those are definitely no-brainers. However, the Visa example, I think, and again, this is where, like, if you dive into a business, you see the dislocations happening over time. Mm-hmm. I mean, it's payments, for example, is an area X regulations, and we've seen, like, for example, deregulation happen in Europe, right, for PSD2 and GDPR, and in the United States, there's something called CCNA, I think it's called, California
CCPA,
Consumer Privacy, CCPA, yeah. So I mean, this concept of open banking, and then sort of like you see these dislocations happening over time with companies that are coming from different angles. For example, Square is offering essentially node to node, like, cash transfer and payments and things like that. So I mean, a great example of, like, buying a company that will definitely rebound because of a major macroeconomic dislocation. But if you do the research, then you start studying, you're saying, okay, well, who's coming up the side, right? Who's going to start, like, jamming the knife in the liver over time? And that's a company that might have that dislocation, that moat erode over time, given, like, you know, economic realities or, you know, technological evolutions. So that's very interesting. You brought that up there. This is a really interesting example.
Yeah.
Yeah,
I think it's definitely an interesting debate, right? Like, there's lots of potential competitors. There's Apple Pay, there's Square, there's I don't even know who does Venmo and Zelle and all of that. But yeah, I think that if a company is well positioned, it's just going to keep crushing it, depending on the management, depending on the overall industry, and, you know, what's going on. For example, like, this is an interesting topic. Airlines, right? Airlines is an industry that's extremely high costs in capital. Warren Buffett invested in it, but he pulled out recently. But, you know, it was very interesting. Like, how do you know which one is going to survive over the long haul? Like, which one's going to get bailed out? And are you just gambling if you're betting on the company to survive? Or, you know, what are your guys' takes on that type of situation?
Wait, can we stick to my first question, then we can go to that one?
Sure.
I want to know what everyone's convictions are.
So for me, well, number one, I've never invested in airlines. I missed out on the whole rise, and it was hard to not FOMO, but I hate it. I've never had a great experience with airlines. I think their product is a piece of shit, basically. In the US, at least, it's terrible.
In the US, yeah, for sure.
Yeah, if you consider the air riding, like, Delta Airlines as an experience and using a brand new iPhone for the first time, I would much prefer using the iPhone. I think it's just not a good product, so I don't invest in it. And in terms of my convictions, I believe, and this has kind of been my conviction for a while, and it's partially influenced by crypto. The world is increasingly more digital. The line between our reality and what goes on in the digital world are blurring. I'm been bullish on Apple, not because of any of their iPhones or whatever, but because of their investments into virtual reality. So that's something that I'm super interested in. Anything on decentralization is also good. And we're also seeing this whole like tech is COVID resistant, and that kind of gives you an interesting mindset, I guess, where yeah, you don't need products that don't depend on people being there in person. Internet, like the more time that people spend at home, like the internet activity is only going to increase. Like most tech things that depend on communications are going up. So I've been in Twilio for a long time. I love Twilio, but I've been thinking recently about what is tech not resistant to, and you saw that literally yesterday, I think, with the Twitter hack, which was crazy. And so I've been bullish on cybersecurity for a long time. In fact, 20%, I would say, or more of my Roth IRA is in cybersecurity companies. I think over the long term, they're kind of a no-brainer, and they're relatively untapped. And the great thing about cybersecurity is that they produce papers. So if you can understand what these researchers at companies are putting up on like archive, then you can read it and kind of see which ones are where their headspace is and what kind of products they're going to launch. So yeah, so that's kind of like, I'm very bullish on cybersecurity. That's one of my main things right now. And like generally anything where it helps continue the transition of as many things in the physical world into the digital one. Yeah, but I also have never invested in Google and Facebook either, because it's too sketchy for me in terms of like how they're entangled with elections and search results and privacy and everything. So that stuff, to me, it poses a regulatory risk. So I never invested in those companies either, even though I'm very bullish on tech and they do VR and other things.
What kind of cybersecurity companies?
There's a whole bunch, but like one of the ones that I invested in a while ago, like, so it's a no-brainer to me, is Cloudflare. Cloudflare dipped majorly after the last earnings. I think they dipped something like 12% or whatever. So I bought as many shares as I possibly could then, and I think I'm up like 50% so far. And Palo Alto Networks is another decent one. Yeah, I mean, there's generally like I don't know if there's a cybersecurity ETF, but if there is one, like I would probably do that, unless you want to go really deep into the research. But generally, yeah, like if you look at archive, you'll find a bunch of these papers. You can also look up like DevCon and see what topics are really hot there. So that kind of gives you a sense of what the trends are.
Awesome.
Ken, I would like to say I'm generally bullish on Asia. So that's like super macro, but then I'm looking for like more targeted opportunities to invest in companies that will benefit off of the digital currency in China. So I think that's for me is a super no-brainer, but in terms of the space, but I'm not sure about which particular company will benefit the most off of that, because the world on the currency side, it's I don't think Bitcoin is not going to be a transactional currency. It's never going to get the government support. I think I wouldn't bet that Bitcoin's going to like take over the world in terms of transactions. I as full disclosure, I do buy Bitcoin, but I think that as a gold equivalent as opposed to a currency. But if you look at the digital currency in China, I think they're gonna be leading the world, and that's gonna be super huge for whoever can profit off of that.
So that's interesting, Wilmer. Does that include essentially payment networks?
And also another one is I think food is going to be still big, like food
in China.
technology. Like for example,
Also,
there's this one company called like Babylon. That's like this startup where they can do you can take it to companies and you could grow microgreens on the spot, and technology with some AI, with some farming techniques, that kind of stuff I think is a solid bet in the future too. I just don't know enough about it. I'm not an expert in agriculture.
Yeah. Ag tech is getting a lot of investment on the venture capital side as well, but it's very nascent in the United States. That's cool. Thank you. Who wants to go next?
Yeah, I mean, there's one thing that I'm actually having a huge conviction into is of course Asia as well. And I think one of the best way to ride the growth of the Asian economies is really through this company called C Group. I mean, if you look at e-commerce, it's really not hard to tell why e-commerce is a superior solution, because of the selection, the variety, maybe price transparency, and maybe trust as well, right? Because when you go onto a e-commerce platform like Amazon, you can see the reviews, and that means that this is a trustable product and you have confidence because the product is being shipped to you. So if you look at the Southeast Asia, I think it's clearly defined. In China, we have Pinduoduo, we have JD, we have Alibaba. They are the dominant force over there, and I think for a new player to come in would be really quite hard because of how aggressive China competes among itself. I think in America, of course, it's Amazon and a few other smaller ones. But in Southeast Asia, I think people like to define Asia as, just Asia alone. But I think Asia has different flavors, different localization that's required. And actually, there's this company called Lazada that was competing, and until Shopee came in, and I think they dominated them in a very far margin. And if you were to use Google Trends to compare, I think Shopee is actually ahead by a very large margin. And I think in the Southeast Asia, we have, in terms of the internet penetration rate, is not extremely high. We are experiencing high disposable income. And I think one thing is this, I realize in America, people don't use WhatsApp a lot. People use iMessage a lot. So I think iPhone is like a de facto phone kind of thing over there. But in places like India, right, I do think that they don't really have that income to buy an iPhone. Most of them use Android phones, the lower specs phones. And I think in terms of gaming, I think it's still going to grow quite rapidly as well. So these are the two trends I'm seeing. I think e-commerce, I think gaming, I think payments as well. And you get three of this in this company called C Group, right? So if you use Google Trends, App Annie, use various formats, you can see this growing really strongly. So that's one area that I'm focusing on. And I think Kevin also mentioned about cybersecurity, and I'm actually invested in this company called CrowdStrike. So I like the way how they've been detecting viruses. It's a lot better than McAfee, Symantec, and I think they partner with Zscaler, and Palo Alto is one of their competitors as well. And I think there's this big misconceptions about loss-making companies, because if you look at companies like Cloudflare, Datadog, Livongo, all this, they are loss-making. But, if you look at a unit economics, it's actually very positive. And the only reason why they're losing money is because they are going out there to expand the business as much as possible. And by the time, if they have dominated the business, the marketing expense, they can deal it down, and their earnings will just shoot up. It's just the same scenario of Amazon. Back then, they're just spending so much money in R&D and marketing expenses that actually pushes down their earnings. But in fact, beneath these businesses are actually very profitable ones. So those are the places that I have a lot of conviction right now.
Hey, Calvin, quick question on C Group. You'd mentioned they're involved with payments, gaming, as well as e-commerce. Can you elaborate a little more on the gaming and payments that they're innovating on? I'm just kind of curious how it's from the other guys in the United States, for example.
Yeah. So I guess when we look at the gaming portion, I think we need to think of games on a broader scope, because if you look at games like Dota, you look at games like Call of Duty, or of course, you know, in the past we have seen some games that fell off the cliff, you know, got really popular for a while and fell off the cliff. So we call that the blockbuster game. So I think that's not a good recipe. That's not a good business to invest in. So what differentiates, I think, Free Fire, I guess, is really the social element into it, whereby they are really smart in a way whereby, you know, if you get friends together, you actually win more points, you get more experience points together. And I think gaming now is a bit blurry, because sometimes, you know, when you go into the game and you're a game character, you feel like a different person. You feel like you want to engage in that reality, right? So what they do right now, I think, is to get so it's localized. So each country is the same game, but it's just a localized app. So they'll get a localized celebrity to have avatars inside the game characters. They do all this cross collaboration. And I think one thing that's very important is that one good measurement of whether a game has longevity is looking at the tournament money, right? So every time when there's a Free Fire tournament, how many people are going to watch it? You know, those are the metrics that I track a lot. And I think for them...
So Kevin, quick question. Yeah. So how does it connect to the rest of its businesses?
Yeah. So the businesses are actually quite separated. But I think if you look at Forest Lee, you know, I think Seagull is by and far, you know, the largest market cap. And I think they have got there through really good execution. I mean, they started as a gaming company. And since then, you know, whatever money that they created from the gaming company, they have actually funneled into the Shopee business. And I think if you look at the way they have understood the business, is that, you know, you have to, you know, facilitate value, you know, between the merchant and the sellers. And, you know, they have been doing that really, really well by doing very thoughtful trainings to their merchants. And when it comes to selling, they actually provided a very strong platform. So again, I think to answer your question, there's no relation. But I think by the fact that they started this e-commerce company, they actually have embedded some gaming elements into the Shopee app as well. So people could earn coins through playing some games, and that coins could offset the certain purchases. So they made everything. I mean, they added a gamification element to the e-commerce.
Yep. Got it. Got it. Okay, cool. Who wants to go next?
Okay, I guess I'll go next. I'm kind of really into Xerox, and you guys might be thinking that like maybe people aren't using printers a lot, and you know, we're going towards digital documents, which is all like a fair points. But I guess I've gotten really tempted at it because you know, the value of the company is like somewhere around 3.5 billion. But if you look at like their past couple of years cash flow statements, like they do like about $1 billion in cash flow. So I mean, so I mean, if you just kind of like do the back of the envelope calculations, I mean, you would break even like within like three years or so on that account. I like it because they have a lot of their revenues come from like government contracts, and you know, with in my opinion, like governments, like they probably they're not as efficient as like the private sector, so like they'll probably like renew those contracts over and over, so you know, it's a constant source of revenue for Xerox. And also they have like a constant source of revenue because a lot of their revenue is like a monthly income, but a lot of the contracts have like a minimum spend amount, which is usually to pay for the printer. And then you know, they have the variable part, which is like the number of pages that they print.
Kenny, what are you expecting? I'm looking at the chart and the data for Xerox. I've never looked at it before. What are you personally expecting from this stock?
Yeah, I mean, I expect it to double like sometime within the next 5 years, because
Okay.
Like just because my conviction is that they're gonna have those steady the steady revenue. Like there's not gonna be any kind of big disruption. And like if you look at like say the past like 5 or 10 years, it's been around what like maybe $30 to $40. I think it can get to that level in the price.
Hey Kenny, can I just step in to just share with you my thoughts on this? Because I think a lot of times people look at low valuations and they think that, hey, that's really interesting, that's a value buy. And I think we will not blame, you know, people from looking in that way. But if you look at Xerox, right, I think since the year 2012 until right now, there's not a single year where the revenue have actually increased. It have actually fallen instead. And I think with this COVID-19, it was actually an opportunity for a lot of companies like DocuSign, like VeriSign, that actually do digitalize paper transfers. And I see that acceleration in digital adoption, and there's a lot less printing happening. And you know that draws a same parallel to this company called GameStop. Is a company that sells consumer electronics, but who buys consumer electronics in terms of the gaming merchandise anymore? A lot of people is all digitalized, right? You just download it online. You don't go to the shop to buy the CDs anymore. So the reason why I think Xerox, if you look at it since 2012, 2018, it has never grown a lot because people might be expecting a value disruption inside. So I'm not saying you're wrong, but I think this is a perspective that you have to consider.
Oh yeah. I definitely agree that is true that the revenue has been like flat, you know, pretty much like the past few years. In fact, I think that's one of their current initiatives is cost cutting. They're trying to cut like 1.5 billion in expenses. But yeah, Kelvin, that is a very good point. But even though still like I feel that like because I'm kind of like dipping my feet in this this company. Like right now, I've probably only got about $4,500 invested because I'm comfortable either way. Like because if it goes up, then that's just I mean that's just easy profits for me. But if it goes down, like let's say the price halves, which you know, I still think it would be a good value buy because I think like the fundamentals of Xerox is better than GameStop. I think a little bit.
It's got a good.
Yeah, I would imagine so. Thanks, Kenny. Let's move on to the next person. Who wants to go next? Katai, do you want to go?
For me, I can't buy stocks as part of my work, so they make it incredibly difficult to buy stocks. But I think a lot of the things that I'm hearing.
That's not the question, though. Yeah.
Yeah, I think a lot of the things I'm hearing from you guys are more. It's very similar to Peter Lynch. I don't know if you've read his book before.
One Up on Wall Street.
Yeah, it's just observing kind of what's going on around you and picking up on those things. That seems to be easier than trying to go source something obscure that no one's looked at. I don't have any particular trends I'm thinking about, but I think definitely the remote, work from home is definitely a big trend, and I expect commercial real estate to really suffer from that. That's what I would think. I don't have any bets or anything like that I'm making.
Yeah, what are you excited about?
I also have to report all of my trades.
What am I excited about?
Yeah. It doesn't have to be investment related, but maybe it's something that you've noticed recently.
Yeah, I think definitely there's a trend with I would say probably the grocery store is kind of interesting, but I'm not really sold on that because I'm not sure how the habits will change, once the lockdown is relieved. I think a lot of people have rotated to more being at home and things like that. Actually, you know what I am excited about is from an institutional perspective, there's actually trillions of dollars of cash sitting on the sidelines. I guess I'll say that. And there's been a lot of discussion about whether or not the market as a whole has room to run. And I think this is kind of that. There's also the biggest deviation or, widest gap between growth and value right now. So we do tilt to value as part of our strategy. And I think that's kind of where I'm looking to.
Yeah, there's a lot of dry powder apparently out in the market.
Yeah, in the last few days, value has definitely pulled through a little bit better than growth, and it'll be interesting to see just kind of what that capitulation looks like when the growth trade has kind of run its course. I think it'll be pretty strong, if that helps.
Got it.
But I'm not a big risk taker when it comes to stocks. What I will say is I do take a couple $1,000s and throw it into a 3x fund just to trade, not to invest.
Yeah.
And yeah, that's about it. I'm actually curious. I have a separate question just to pose, but to answer after Kenneth's. But just in terms of taxes, do you guys do most of your trading in tax deferred accounts, or are you actually like ponying up cash every year to pay for taxes?
Okay, let's put that at the end.
That's separate.
Yeah. Sam, do you want to go?
Who did you say, me?
Yeah.
Yeah, what I have a lot of conviction on, the companies I traditionally focus on are tech, finance, and some defense. The reason defense, I also like cybersecurity and, things that have trends for the future. I like companies that have a lot of positive cash flow, that are continuously growing them and have good prospects for the future. The reason defense is because America is very warmongery. It's going to continue to be that way for the foreseeable future, and we spend a lot. And they're all government contracts, and they're basically not going to stop spending. So those are pretty much guaranteed revenues. Basically, when you can pick it up on a discount, that's a good opportunity. Finance runs our world, and I think a lot of the big players are going to continue to stay that way, absent some sort of seismic regulatory shift. I think there is room for other players such as digital currencies, but I think lots of payment facilitators and those sort of companies help smooth the transition from a cash-based society to a more digital society, which is still playing out in many parts of the world. We don't see that as much here in the US. I mean, obviously we are still shifting towards digital payments and so on, but in other parts of the world, it's still growing, like Brazil and so on. China uses their own softwares for everything. And then the final one, tech. Tech is also an integral part of our everyday lives, and basically whatever has like a seismic impact on our lives is interesting. But I don't like these companies that don't have strong cash flows yet and don't have like a promise of like, are people actually going to buy and adopt them? I prefer to wait for more surefire opportunities.
Yep. Great. That's very interesting and helpful. Kevin, I see you up there. Would you like to go?
So yeah, I mean, mine's mainly like tech, cybersec, but so one interesting insight is, so I just finished Y Combinator in winter, and the batch size for our batch was 250 companies. That's up, I think, 70% from the batch before that. And I will tell you that about 50% of the companies was doing what worked before with tech in the United States, like your typical arbitrage solutions. So, like they'll be like AI. So like we have this joke where AI just means Asian in a box, because there's some guy in the Philippines or whatever who's willing to do data entry for like $1 an hour. So like there's a lot of like those kind of labor arbitrage companies, and they just take what worked in the US and they do it in foreign countries. I'm seeing it with cards, I'm seeing it with payments. Literally, like there's so many companies where it's like payments processing. It's like Stripe, but for Latin America. Like it's like Brex, but for Brazil. It's heating up, and like, yeah, it makes sense, right? Because like the alternative is, because the barrier to coding has gotten so low, and money is almost free with low interest rates, right? It's like ZERP, or like zero interest rate protocol, like that basically governs a lot of venture capital. And you're seeing people are judging the risk. It's like, okay, we have the ability to invest in these kind of like emerging markets and do the same thing. We know it works. We have the cloud, so we can just do it, or we can try to hunt for yet another like harder tech solution. So you're going to take the easy way out. So yeah, I think like I agree with Sam a lot on like the whole finance in like other countries. That's definitely promising. Yeah, for me, like mainly cybersecurity, defense. Funnily enough, like it's like super against what I normally do, but I bought I have 2 grocery stocks that I'm holding right now, which is Chef's Warehouse and BJ's, because I think the food supply, like basically I think that more middlemen are going to get cut out, and you're going to move further up the supply chain. Like I can order groceries at restaurant prices from restaurant suppliers, and Chef's Warehouse is one of them. And like, yeah, people want to buy wholesale. Costco's super expensive and they're global. I think it poses more of a logistical and supply chain risk. So BJ's is only on the East Coast. And they were doing really well in New York during the pandemic. So I bought some BJ's, which is up a little bit. But yeah, and then like digital identity, anything that kind of helps, like I said, ease that transition into like a more digital world, I think is good. And I really like buying cybersecurity and tech together, mainly because I view cybersecurity almost as insurance for the technology industry. And I think that, you know, it's like, if there's a hack, tech is generally going to go well every year, unless there's kind of like a hack or something like that for software. And if that is, like, hopefully my cybersecurity stock is the company that is that owns that contract.
Yep.
So that's kind of my thesis.
Interesting. And so, in other words, you're saying that venture has run out of ideas.
Yeah, you're pretty much right. Like you're seeing a lot. One thing that I am interested in about, and Ken, I think you'll appreciate this too. OpenAI, which I think is Sam Altman from YC and Elon Musk. I think Elon Musk is no longer on it, but they recently in June released something called GPT-3. If anyone's interested in tech, or you want to understand where the industry is heading, I would check it out. Basically, if you look up GPT-3 Python code, you'll see on YouTube that an AI can pretty much write code, complex code, within like 2 seconds. I'm gonna admit it, like it writes code better than I can. And I think like there is a lot of potential for no code. It's been heating up. Software is constantly modular. Like most software can be automated. So I don't know if there's any stocks that are like doing no code things, but if there were, then I would probably also invest in that.
Yeah, the singularity is arriving sooner than we expect.
It is.
Very interesting stuff.
So hey, I've got one too. One more, Ken. And this is in Vancouver. So I'm in real estate development here, right? And there is like a really big push, and you'll probably see it in New York City too. There's a really big push away from condos, from elevators. So in real estate, people are spending more money. Like a single family home in Vancouver is like well over $1 million just for the land, never mind the building. And there's a lot of people, because of COVID, they don't want to get into an elevator. So whether it's multifamily that doesn't have a elevator, or whether it's a single family home, whether it's a duplex, there's more people are trying to be more live more socially distanced. So people are buying, if they're going to buy a condo, they're going to buy a 3-bedroom. They're going to try to stretch to buy a 3-bedroom condo if there's only 2 people, so that they can have a home office. So there's that trend in real estate. I don't know if that you see it in New York City or other big urban centers,
Well,
but
one thing in New York City is that there's definitely a trend where people are moving out of the city. That's for sure. So the boroughs are in like Jersey, for example, you're starting to see a lot more people move out there. But there's a lot of commercial real estate, and I definitely foresee something, the bottom dropping fairly soon. There's a lot of noise out there and people are very sanguine about it, but I'm not sure it's 100% true. But I don't know. Guys, also I want to be conscious of everyone's time, so I'm just going to ask everybody, like, are there other people who want to go? If you don't want to go, it's okay. But if you're feeling pretty hyped up about an idea, feel free to share it. Now's the time. No? Sean, I know you were, well, he's away from his desk. Annie, Sheena, Cody, Albona. Anything
I
you guys?
have to go, guys, but I want to ask the group one question. Just, it's like more of a poll, and I want to check myself because I want to check whether I'm wrong or not. How many people are saving up, storing up cash for a second dip? Can you raise your hand?
It's like
it's about 50%, huh?
Yeah.
Okay. It's lower than I expected.
Yeah, I don't care if there's a dip.
Okay.
Yeah. I guess I'll go last, I guess, maybe, and then we'll close it out. Maybe, Sam, do you think?
Yeah, I think that's
okay.
Good. Nice 2-hour
Yeah.
session.
Yeah, definitely. Definitely a good discussion, guys, and also highly engaged. So I love hearing everyone's points of views. Well, I was gonna say what I'm excited about. My again, I have a very specific hypothesis about what the future looks like. So everything kind of flows through this filter to me. There's a confluence of things happening at the same time, right? So we talked about AI a little bit. We talked about, gene editing. I think someone here from Illumina. We also, there's also the element of robotics, energy storage, for example, 5G. So I'm looking at how the world looks when all these technologies begin to converge. And the last time this happened, someone actually mentioned the inverted yield curve was what caused them to sell at a certain point. In the late 1800s, up until the Great Depression, that was the last time 3 major technologies converged at the same time: telephony, electricity, and the internal combustion engine, right? And the inverted yield curve happened, like, I think 5 times in that period of time. So I guess what I'm saying is that there's a major deflationary effect to these things, and they happen very rarely. So I guess the short answer is, if you look at the world in those lenses, I'm excited about all those things. I don't know if I can name stocks that really make a lot of sense at this point, because you guys may be like, what the fuck is he talking about? So I'll just leave it there.
So yours was 5G, energy storage, and what was the third one?
There's a whole bunch of them. So basically it's AI. I think blockchain belongs in that. Battery technology, like energy storage, as you mentioned. Robotics, I think is extremely interesting. So essentially IoT, robotics, those elements. Yeah, and look, they don't happen in isolation, right? So for example, fintech is a combination of AI, payments, and to a certain extent, like, the evolution of cryptocurrencies and like, blockchain. Like, these evolutions don't happen in isolation. They are, if you draw a Venn diagram, they combine many different types of technologies in one single sector. So that's why I'm looking at not just like single plays. Like, again, I told you my filter is that I don't give a shit about how a company's going to do tomorrow. I also don't care if it's going to do well, like it's an incremental gain. I care if it's going to be a monopoly. I don't give a fuck about anything else. I want to invest in monopolies only. So if that's the case, who's going to converge all those technologies and own the market? That's my filter. And I encourage you guys to like read up on like stuff to connect the dots. And I would love to hear what you guys come up with, because and maybe we can use this as an opportunity to share and like poke holes into each other's ideas, right? And then identify the next, like Amazon, identify the next Google or Facebook.
Ken, I like AI and robotics, and I agree with what you're saying. My challenge with that is I have a trouble picking a clear winner, like which company is going to crush it. And that's why I don't invest unless I know. And I mean, if you have a strong conviction that there's a particular company, I'd love to investigate it. But for me, I haven't been able to find a company that I know for sure is going to dominate this field in either AI or robotics.
So I agree, but the way I see it is you can literally see if you just do a little bit of research, you can see this confluence happening. So like I tried, like Google Stadia is a cloud gaming company. What that means is that no matter what company you have, no matter what computer you have, you can play like really highly intensive games like on your MacBook, right? And it sucked 2 years ago. I mean, it was terrible, unusable, garbage. I tried it today, and if you're not a professional gamer, like it'll work for a lot of games. And so like 5G and the potential of what it does when an increase in connectivity, the potential of that is huge, right? So like, but how do you even just invest with knowing that kind of thesis? Well, so I think like the way that I would treat it is you understand kind of where the market is going, and it's not going to happen tomorrow. It's not going to happen in a week. It's happening every day for a long period of time. And so, if you want to just buy something and forget it, that's going to be a hard decision. But if you're checking up like every month and you have a handful of things, they're all probably going to do relatively well, like as long as they follow this trend. And as time goes on, you can kind of like decide which one is kind of you think is going to do better than the others, and it pretty much put more money in it. Or if you don't want to put more money in it, then resize or rebalance how you're allocating your capital. So like that way you're not necessarily waiting for the perfect one, or like, I don't like waiting for perfect things. I don't like waiting for dips, because it creates so much psychological like bias that it often leads to inaction, and then I forget about it, and then like 1 year later I'm like, wow, like why didn't I do that? So I prefer to just enter, even if it's like right now it could be the worst possible time to buy it, but it's aligns with my thesis for like a 20 year, 30 year thesis. I would put like 0.1% of my portfolio in it, just so that it's right there, like it's on my watch list, and it kind of like psychologically occupies a space. Because like you're investing time too, that's kind of a look at it.
Yeah, you said something that was really interesting. Basically, someone said, when's the right time to enter and when's a good time to exit? And the answer is there's never a good time. You either have enough information to enter and take a position, and to over time build it, or you're just simply gonna enter a state of analysis paralysis, and you will never enter it. So that's definitely the one thing. The other thing that I want to note before passing back to you guys is, Warren Buffett said, basically investing is like a kind of baseball game where you don't have to take a swing at every pitch that comes your way. You can swing 1 out of every 100 times, and you hit that home run. That's your Coca-Cola, right? So you can sit there and analyze until you have the conviction. You don't need to take a position, and maybe the market hasn't even developed yet, right? Like no one thought that EVs would be as exciting and hot as it is today. 5 years ago, Detroit was like the dominant like vehicle group in the world, and no one could ever foresee Tesla being valued what it is today. Now we'll see in 5 years whether they'll hang around, but the Overton window of what is acceptable shifts over time. Society may not be ready for distributed apps today, right? But over time it will. And if you don't watch it and you don't, have a hypothesis or position, you'll never enter. So
I agree. I think my take on it is basically when I see a interesting industry, I just put the most interesting companies on a target watch list. I just read about it over time, like over a period of a couple of years sometimes. And then when I have full conviction, that's when I invest.
Well, awesome, guys. I think it's like 10:07. Well, my time. For you guys, it's 7 p.m. But yeah, do you think this is a good stopping point, Sam?
Yeah, I think so. We could theoretically go all night, so I think we should just table this and have a continued discussion another time.
Mhm.
Well, great. I mean, what I would actually ask, I just love this group because you guys all have like very, very good insights and different perspectives. I would love if we could talk about this in another 2 weeks or another month and come back and say, okay, I've done my homework and here's what I'm super excited about. And have everyone kind of, take a chance to kind of ask questions and maybe poke a little hole here and there. I think it allows us to be a lot more hardened with our hypotheses, and also it's informative. Like it allows us to learn where other people's perspectives are. So would you guys be up for doing that?
Yes. Oh, sorry, I was too
Definitely.
quick. Yes.
Awesome.
Love
Yeah.
that enthusiasm. Yeah, sounds great.
Love it. Cool. Well, thank you so much, guys. We'll
Thanks,
share
guys.
this recording.
Yep, we'll post
Awesome.
that probably next week. Thank you
Cool.
for joining, everyone.
Thank
Thanks.
you.
Cool.
Have a good one, guys.
Bye.
Thank you.
Have a good night,
Bye-bye.
everybody.
Everybody.
Bye.